Hello, everyone, and welcome to another episode of the TechTrends Podcast. As I always say, this show is where we explore the latest in tech, innovation, and of course, the digital economy shaping Africa. And I'm your host, Nixon Kanali. And today, I'm really excited, to get into this discussion. And of course, we are diving into a critical and timely conversation on digital assets in Africa and stablecoins adoption across Africa. And of course, we're going to be talking about how governments are racing up to catch with effective regulation. It's a very, very important factor. And of course, joining me in this episode is
Edline Murungi, and I am Legal Counsel at Yellow Card.
Yeah, and if you don't know Yellow Card is actually one of the continent's leading stablecoin infrastructure providers. And of course, with me, Edline is actually be helping me unpack key insights for the report you released recently. That talks about regulations in Africa. And of course, it's actually the first comprehensive analysis of digital assets regulation in Africa that I read. Mm-hmm. And you mentioned this is your first podcast you're appearing in.
Yes, this is my first podcast.
Oh, you've never done a podcast?
So I watched so many podcasts, but for some reason, I was mentioning you too earlier that lawyers are supposed to be behind the scenes. We're supposed to advise people to go on podcasts and go on TV and what to say and what not to say. So it's interesting that I'm now on a podcast.
Yeah, but I was telling you, I know lawyers always talk too much.
I do talk too much.
So there'll be a very good fit for a podcast discussion.
I think it would, but for some reason, I think it's just our training. We've been conditioned to sort of not advertise yourself, be behind the scenes, advise the people, advise the politician so that you are not the politician. So, but excited to be here.
All right, welcome to the podcast, Edline. And just let's get started. Why was it important for you to actually put this report now? I mean, what drove the timing?
So if you've not noticed, or if you've noticed, there's like a wave of regulation of digital assets across the globe and across Africa. And we kept looking internally for resources on something comprehensive, especially about Africa and digital assets regulation in Africa, and we really couldn't find anything. So we came up with an idea to put out this resource that can be used by really anyone. It's not very legal in nature. Yeah. It can be used by tech enthusiasts. It can be used by entrepreneurs. It can be used by anyone who is interested in the space. So the resource puts together comprehensive laws and really the regulation of digital assets in Africa. And that's where we came from. We want the world and Africa to have a piece of resource that they can refer to. So that's why we wanted to have something. Yeah,
I was even with you at the launch actually. Is it Serena? Yeah, at the launch, and I was reading the report, and the numbers were actually very interesting because we're looking at 54 million digital assets users in Africa, I think, with sub-Saharan Africa actually, leading globally in stablecoin adoption, according to what I picked from the report. And that's a very massive number when you look at it. What do you think is actually fueling this adoption, especially in countries like Nigeria, Kenya? Actually, whenever you mention anything about crypto, stablecoins, digital assets, Kenya, Nigeria, and always top in South Africa.
And South Africa.
What do you think is actually fueling this adoption?
So specifically for stablecoins, they are it's what people call digital dollars. Yeah. So, and in Africa, we've always had a problem with cross-border payments. We have some of the most expensive cross-border payments, remittance. We also have some of the most inefficient. And so you'll find that people, the thing about human beings is that they will always find a solution. They'll always want to find a solution where there's an obstacle. So stablecoin adoption has really been fueled by that. People want to be able to move money around at a low cost, very swiftly, very quickly. So that's what has really brought this up. And we've also had waves of unstable currencies over the past few years. Our currencies are up and down, and you find that the dollar has been stable. And unfortunately, the dollar is the one that's used for most cross-border payments. If you're buying goods from China, you'll still pay in dollars. If you're buying anything from, let's say, the UK, anything, even if you're buying something from Kenya, let's say you're in Uganda, you still end up transacting in the dollar. Yeah. So the digital dollars sort of replaced the physical dollars, and it's still fueled by cross-border transactions and the need to do business swiftly and in a very efficient manner. And again, the three economies, it's because they're the three biggest economies in Africa. Ethiopia, Kenya, Nigeria, of course, and South Africa. So usually the stablecoin adoption is because of advancement in technology, and so that they've also been the technologies that have moved relatively faster than others.
Yeah, interestingly, I always hear this conversation around how we've actually been using stablecoins. Like I remember, your colleague talking about even M-Pesa being a digital asset. But I mean, it's a digital asset actually, but people just don't know.
Yes, so it's just that it's based on fiat currency. Exactly. Yeah. Okay. So it's based on fiat currency, and there's also been talk of the Kenyan stablecoin. I know some people working on the Kenyan stablecoin. Yeah. So for the Kenyan stablecoin, it will most likely fuel domestic transactions, because most cross-border transactions are still based on the USD and things like that. Yeah. But countries are moving to also local currency stablecoins as well. And
that's interesting. In the report you mentioned that 10 African countries are now in the global top 50 for crypto or stablecoins adoption. Of course, this includes Nigeria, Ethiopia, Kenya, South Africa, and Ghana. Did this level of adoption actually surprise you as Yellow Card?
For me, again, no. Because if you look at the adoption of crypto and stablecoins, they come to solve a problem. Yeah. And if anyone tells you if they've ever lived maybe in the UK or in the US, you will find that they don't have that problem. A person who earns in dollars, pays everything in dollars, their bank account is in dollars, does not have that problem. So whereas you find generally, I will say the global south, because I feel like it's also spreading to Latin America and to the rest of the global south, they still have the problem of people unbanked. Yeah. So I don't have a bank account in the first place. And yet with crypto adoption, you can transact without a bank account. And then Kenya is a bit very advanced because of M-Pesa, and almost, I think, even the most rural person knows how to use an M-Pesa wallet. Yeah. Anyone you will find in Kenya can use. But you'll find other countries telling them to go to the bank or to do what you call traditional finance is something that they can't do. So the reason why the adoption is still within the African countries is also because they're the ones that are racing towards development and emerging economies. Yeah. And you find stablecoins and crypto offer that solution of where the rest of the traditional finance is leaving you behind. You must find a way to still do business, transact. So that's really how it has come about.
Right, interesting. Let's just switch back to Kenya, and the legal view of it. Actually Kenya is on the track to actually pass the what the report called the most comprehensive and progressive digital asset legislation on the continent. And we've covered that report extensively actually on our publication. But what do you think Kenya's approach actually? What do you think makes Kenya's approach actually stand out?
Yes, so it's true. Kenya is about to pass the most comprehensive Federal Assets Act. And in fact, there is a hearing today in Parliament, probably the third hearing. It's today. It was supposed to be last week, but we had some protests. So if you look at the other digital asset legislation, so I'm going to focus on Africa, Mauritius, Botswana, those are sort of the ones that came around 2020, 2021, 2022. You see that they had this standard sort of layout where they would create the licensing regime, and then they create the authority that's going to manage the service providers, and then they deal with consumer protection and those other things and penalties as usual. However, over the past, and that's because primarily when people first heard about crypto, everyone just knew Bitcoin, right? We all knew Bitcoin. And even me, when I joined the industry, I just knew Bitcoin, maybe Ethereum. I had never heard of USDT or USDC. Like no one really knew about the stablecoins and the fact that they are the ones driving the industry. And then come 2020 during COVID, when we were all at home and you could not, I'm from Uganda, so people in Kenya had it easy. You guys could drive your cars and move around during COVID. We could not. We had a total lockdown. You were not allowed to leave your house unless you were sick or it was a matter of life and death. So they told everyone, go to the nearest market, buy food from there, and that was it. So what did that mean? That meant that everything had to be done online. And that's when the onset of stablecoin adoption became really huge, because people wanted something that's not dollars, because now I can't even go outside to buy dollars, but that does the same thing as the dollar. And that's when we saw the bullish rest of the in terms of stablecoins. So from 2022, the narration sort of changed away from Bitcoin to now stablecoins, and they are now 99% of the transactions. 99% of the transactions are in stablecoins within the crypto industry. So when that shift happened, we realized that people don't do cryptocurrency for investments. They're doing it as a form of, they're facilitating payments, and most times cross-border payments. So we shifted. If you look at laws, the investment laws are different from payment systems laws. Payment systems and money moving across borders is usually central bank. They're the ones that want to know how much money came into the country, how much money left, how many dollars do we have, how many Kenya shillings do we have. That's the role of the central bank. Whereas if you look at stocks, for example, if you buy an asset and the asset expands and matures, that's the role of the Capital Markets Authority. They're the ones that deal with markets. So we now got an instrument or a thing that does both. It does both capital markets or markets, investments, and also does payments. Actually, that has been the biggest conundrum in crypto. So you will find the original laws had as if focused on it as an investment and as a security, commodity, any of those things. Whereas the newer laws were like, but wait, people are using it to facilitate cross-border payments. So the reason why the Kenyan law became very, very important, it was the first law where we saw the definition of the authority or the regulators that are going to be in charge is both the CBK and the CMA. And actually any other authority, as you will see, it might change in nature of how it's being used. So that approach of both the CBK and the CMA has actually been adopted by Rwanda. Is probably going to be adopted by Uganda, as we all know. You know how the laws around the region move.
They're always always similar.
They're always similar. And since Kenya is always the first, and they're like, it's the first, it's great, it's good, why should we redo it? So you'll see, I think, around the region, having both the central bank and the Capital Markets Authority. That is not the same in other countries. Other countries, even Nigeria, has only the SEC, which is similar to the CMA. Even when you see in Japan and Singapore, it's a non-banking authority. It's never both. It's very rare to find both. So that's why the Kenyan law is very, very special.
But I actually love the fact that we are having these laws in place, because I remember previously when the conversation around crypto started coming up in Kenya, the previous CBK governor, Njuguna, used to be really against you mention anything crypto and go for these press conferences, they're like, no, it's unregulated and all those things. But when we see them loosen up and say, okay, we are ready to accommodate these, and even now banks are now willing, like, okay, we can actually work something out.
They're ready to come on board.
I
always say this: it's not the business of regulators to steer markets. Markets do what markets do, and then regulators regulate the market.
Because it's easy to control markets, actually.
Yes.
I mean, it's really hard to control
markets. It's hard to control markets.
Yeah.
So if something is not, there's something in fintech especially, or business, if the thing doesn't work, it won't stick.
Yeah. Mm-hmm.
If the product is not useful, if it's not being used for something, it will not stay. So your role as a regulator is not to direct where the market should go, is to see where the market is going, and then now put rules in place to sort of govern that market. So I understand where the traditional regulators were coming from. And I think the main problem they had was because they could not touch, in economics, they want to touch where is the value coming from. And so they really couldn't find that thing with crypto. But now we've seen the value in the cross-border payments and also in the speculation of Bitcoin and its scarcity and things like that. So that has sort of changed. But what I think the regulators missed at that point was they really could have had an opportunity to put these entities and the service providers within the ecosystem and watch them as the thing was happening. And so I feel like that was a missed opportunity, and now we are moving towards regulation because they realized it's been, when did crypto start? 20 what? After the financial crisis, the one of 2008. So it's been 15. We're about to reach the 20-year mark, and we're just getting laws 12 years down the line, 12, 15 years down the line. So the role of regulators is really to see where the market is going, and then now sort of put parameters in place, like goalposts of don't really do this, and then, sort of just regulate the industry. And also the fact that the regulators delayed and over-speculated actually led to most of the crypto, what I would like to call the crypto scams and the bad actors. FTX situation. FTX could have been saved by a few rules of, if you have people's money, do not put it here. If you have, if you're collecting money, it should be in a certain bank account. You should have minimum payments. Who are your directors? Do they have history of financial crime? If just small rules had been in place.
The same way they just treat how you treat, anything that getting from the market. Put them in a sandbox. Let's try. Let's see if this works. If
Let's
it works,
see. So I feel like the regulators had a missed opportunity at that point, and I do understand where they were coming from, but it was a really missed opportunity. So in most economies, we do a lot of regulatory engagement, and I tell them, what is the harm of having these entities in a regulatory sandbox, and you see what they do? And you realize it's cross-border payments, movement of money, adding value, creating jobs. At the end of the day, it's just a new financial digital industry that's being created. And if you really regulate bad actors, then you're very likely to have the bad things that happened within the industry. I think some of the things could have been avoided.
Interesting. We're also seeing, different approaches from, different countries across Africa. Of course, we're looking at, for example, complete bans to some brokers in some countries, to full legislation. How is this regulatory patchwork impacting innovation and cross-border payments from your point of view?
That's true. So the crypto industry has really been one of those industries where everything has happened. There has been complete bans. We even saw that in Nigeria, Egypt, so most of Maghreb, Morocco, Tunisia, they have complete bans. And then they realized, because of the access to internet and the era in which we live, complete bans do not work. So when Nigeria had the complete ban, it lasted 6 months?
It didn't last long.
It didn't last long at all, because what happened, everyone would just access a VPN and they still transact. It's very similar to countries that ban social media, and then you find the government is still posting on Facebook, on social media, which means that you can still access that medium as long as you access internet using VPNs. So they now realized it's actually very dangerous for people within the ecosystem and the country to be accessing financial services, one using VPNs. It puts the country at risk to bad actors on the dark web.
Yeah.
And then they also realized it means the country cannot see.
Yeah.
They can't see the transactions that are happening. So they were like, wait, we made a mistake. Please, can we have you now come back and either enter a sandbox or create a law so that now you can do self-reporting and they know. How do we get those figures? Most of those figures, by the way, are from Chainalysis, and they use IP addresses, but they are not completely accurate. They could be, the people using VPNs, those IP addresses are sending you to God knows where. So I always tell people that whatever figure you have, just know it's more than that. So if it was free flow, governments would actually have exact numbers. They would know this is the amount of money in the economy that's passing through stablecoins. This is the one that's going through virtual assets and crypto. The speculative assets. You would have your numbers right. And if you have your numbers right, then you can actually develop regulation that's really suitable for your country. So the bans didn't really work, and that's now how we evolved to regulation. So everyone is now in the regulation phase.
Then how then do you think regulators should manage this tension between enforcement and embracing innovation?
That's a tricky one, because the biggest challenge with regulators, as you can see, most of the regulators in the existing scene are traditional regulators. So they have either regulated banks or funds, capital markets, securities, things like that. And most recently, fintechs. So they have these traditional things of this is what is done in the industry. You must have how many directors, you must have minimum share capital. So one of the things that we've been advocating for is that the industry is new and the regulators should put off half their regulator hat. So you still do need the oversight because, again, they're bad actors in everything. But let them also understand that the industry is a startup industry. So where in banking or in fintech, the requirement is 10 million, put the requirements this side, let's say 2 million. Where the requirement for directors is 3, put the requirements this side maybe 1 or 2. Where the requirement, so make the requirements such that you allow that tech bro who is in his basement or somewhere in their father's garage to actually be able to create something. Because if we box out the people who were the original creators of this thing, then we won't have more innovation.
Exactly. It's basically stifling innovation.
So and one of the things they've introduced in the bill, the virtual assets bill for Kenya, is that there is a sandbox. So the good thing with sandboxes, you don't have to be a company, you don't have to be a corporate, you don't have to have anything. You just have to have something that you want to test. You don't even have to have like a fully functional. You just have to have a product. And the product somehow works, and you say, maybe I want to test 100 students at Nairobi University, and this is what I want them to do. I know people now doing like products in saving. So let's say you want to do a crypto product in saving, and your target is university students. You can now do that under the sandbox.
And CMA is always very open, actually.
Yes.
I love that about them.
CMA has always been very, very open.
Oh, interesting.
So the sandbox should be able to cover for innovation, while at the same time you're encouraging regulation within the bigger players in the market.
Oh, interesting. Let's switch to another part the report touches on risks, right? There are a lot of divergent anti-money laundering and counterfeiting terrorism, CFT's rules, right? The report is talking about, how big is their concern for platforms like Yellow Card?
It's very big. AML is one of the biggest things and one of the biggest risks because if you look at traditional crypto, you can do $1 billion transaction. Imagine. You can do $1 billion transaction. And traditional crypto with anonymous hosts and the anonymity of the wallet addresses. The good thing with the blockchain is that the transaction will always be there, but it will be hard for you to find who did it and who the person was.
Security, right?
Yes.
Yeah.
So platforms that are offering especially exchange services, exchange literally means people are able to buy crypto assets using their local currencies. So you get Kenyan shillings and you're able to buy USDT, Bitcoin, very similar to the stock exchange, how you can go and buy any shares or any stock. So the reason why it's very important is that now those exchanges are in the middle of the other side and also the traditional finance. So the reason why it's very, very important to have those rules and to have KYC and also KYB for businesses is that you need to know whom you're transacting with, because they are sanctioned individuals, they are PEPs, those are politically exposed people. So there are rules in which you have to transact. And also what we have at Yellow Card is actually very special because while traditional finance does only fiat AML, we do both fiat and crypto. What does that mean? Since people are exchanging local currency for the virtual assets, we also do monitoring of wallets. So the exact same way you find bank accounts have been blacklisted in the traditional finance, you will find wallets have been blacklisted in the on crypto on the blockchain. So every time a wallet is either blacklisted, whether it's by an exchange or even by entities like the FBI or things like that, you can't send or receive money from such wallets. So those rules have to be implemented. And there's also been a bit of lag in the industry in terms of AML because the global setting body already added virtual asset service providers as entities, accountable persons. In the region, I'm going to talk about the region, Uganda was the first to actually add in 2020 to add virtual asset service providers. Rwanda did it only in January. Tanzania did it in 2022. Kenya, by the way, has lagged behind on this one because imagine they're implementing a law and only now are they adding virtual asset service providers as accountable persons. And yet they could have been monitoring these transactions even before regulation happened. So, but now it's a requirement for all virtual asset service providers to observe the strictest rules in AML, very similar to financial, other financial institutions. They are considered a financial institution as well.
Oh, interesting. Then, of course, the issue of taxation, which, of course, you talk about taxation in Kenya. It's a whole new debate.
I can now smile.
Yes. So
if we had done this podcast last week, I would not be smiling.
Because there seemed like it's like should I call it a regulatory gray zone?
Yes.
Because some countries are adapting, others actually being punitive. What's your take on the right approach to taxing digital assets without now stifling innovation? Yes.
So the OECD has actually released proper guidelines on how to tax digital assets. So you remember the comparison that I gave you on how digital assets are both used for payment trails and at the same time they're used for investments. Unfortunately, in our world of taxation, those two things are taxed separately. So you will find that payments systems or service providers have excise duties, have maybe they have like these, and then they pay corporate income tax. Whereas you will find investments have capital gains tax because an investment is supposed to increase and then you pay a percentage of the gain. So that has been the biggest conundrum. So most countries, and this is what we advise, is that you need to cover for both regimes. You need to understand that cryptocurrency is not traditional finance and it goes both ways. So on the first instance is that if it's recognized as an asset where someone buys and holds for long term, not traders, because traders are doing daily They buy today, they sell tomorrow. They buy today morning, they sell in the afternoon. Those are not really holding for investment. So people who hold for long term, when they dispose of the asset, i.e. sell, then you can charge a capital gains tax. So depending on the country's percentage of capital gains, then they will charge that percentage. So that's the one aspect. But that works for long-term holding. So usually we recommend maybe there should be a statutory period within which this applies and things like that. And then for instances where like exchanges or companies that are not necessarily doing the gain thing and they're doing daily trades, it's very similar to Forex. So the tax that Kenya had, which by the way was repealed last week with the new finance bill. So it was this tax, the digital assets tax in Kenya was introduced in 2003 with the Finance Act of 2003. And then we've been sort of lobbying and trying to have the government change their mind since then. But there's been, as you know, there's been a lot of talk with the Finance Acts for the past year. So finally this year, when we told them that if you look at the stablecoins especially and how they operate, they're very, very similar to Forex because you're changing that you're changing $1 equivalent of the digital asset. So if $1 to Kenya shilling is 130, then also the USDT is 130. So you taxing me 3%.
I know that's
before I even do anything. You've taxed the asset. There's no rules in taxation where you tax the asset. You either tax a gain or as if someone is providing a service, then you charge a service fee or something. So once they understood that conundrum, they now changed and said they will charge an excise duty on the service fees that are provided by the service providers. And so that approach is fine. So we mentioned that now for the entities that are providing those services, instead of taxing the asset, they pay corporate income tax like everyone else, you know? And then very similar to how you would tax Forex bureaus or anyone dealing in Forex. They do their annual financials because they make profits off margins and then they pay the corporate income tax off the profit. So that's how now you tax the entities and how you also tax the asset where there is a gain. So that's how it's going to be working
and
for
actually
the industry.
good to understand that.
Yes.
Because I know when you're dealing with I know you guys go to parliament to actually discuss this.
Yes.
Just when you explain to them, they're like, for them it's something new actually. So it's up to players like you to actually explain to them, okay, this is how it works. When you tax this is what happens.
Yeah.
Quite a very interesting conversation. Then of course there's the issue of how digital assets are actually classified. The currencies, securities, commodities. What does this classification actually matter from a legal and compliance perspective?
It matters a lot. First of all, on the issue of currency, actually, leave currency, legal tender is the first point. I think 99% of the world has said that cryptocurrency or digital assets are not legal tender. So what that means that you cannot use it to pay for goods and services the way you would use the Kenyan shilling. So that is very important because it means you cannot sort of force people to take the asset as a form of payment or use it as payment for services. That's the first. And then the classification of commodity, security goes back to that issue of who would first of all be the regulator. If it's commodities, securities, then we're going to go to CMA or SEC, Securities Exchange Commission. And then if it's sort of a currency, the central bank now you're going to have difficult discussions with them because they're like, currencies have certain definitions and what they do, and they are issued usually by a central bank. So if the central bank is not issuing it, then it's for them. They always say it's not a currency,
and they're always very tough.
They're always very tough. Yes, and they will. And so what they created is the CBDC. So the CBDC is probably going to be the digital asset version of currencies. Well, they are central bank digital currencies anyway. That's literally what they are. So most likely in the future, we'll see CBDCs as the currencies, and then digital assets will continue to play a role as both maybe what you'd call instruments, because also in certain economies they've said they're non-securities as well, and they are really investments for speculative purposes, and also they facilitate payments. Yeah. They are not the payment system, but they facilitate payments. So, and that's the other thing that I keep saying. We have these traditional definitions in finance: securities, currency, money, commodities. Why do we want to stick to them? Why don't we create new definitions? What the world is evolving. Thank you. Like, if it's not falling within any of those things, let it be its own thing. Yeah. And that's the challenge we've had with regulation, because they've tried to box it in any one of them and it failed to fit. So let's create new definitions. The word vuvuzela didn't exist until
the World Cup.
Until the World Cup of years. So let's create a new financial definition within the ecosystem. Why not?
I mean, we have the resources and everything to actually do that, right?
Exactly. Yeah,
we do. And regulators actually play a very big role, actually helping us, just achieve this. Now let's talk about that's the future of regulation in Africa, and just looking across the continent. Which countries, I know you mentioned it earlier, but which countries do you see as models for, let me call them thoughtful regulations? And which countries, based on your work at Yellow Card, do you see catching up, fast?
For the crypto industry, I feel like the countries that are going to have what you'd call thoughtful regulation are going to be those ones that are sort of allowing the ecosystem to, whether sandbox or sort of allow the players within the ecosystem. And of course, certain countries like Nigeria, Kenya will inevitably be those countries because of the market size, as well as South Africa. But right now we are seeing South Africa leading that journey, because they first of all have they opened their licensing regime last year and they have over 300 licensed. Whereas within that short period. Whereas if you look at other countries like Mauritius, Botswana, that have had laws for now 4 years, they're still on 6. Okay, given they are very small economies. But the reason why the South Africa case is very, very different, case study is different, is because for them, they've allowed even traditional finance companies to get that license. It's called the CASP license, the Crypto Asset Service Providers License. And the reason why that has happened is because they didn't create it as a separate asset class or something that's completely different and new. They just went in one of their laws where there is financial product and literally added one line, financial product, and added crypto asset. So crypto assets were added under financial product. That is banking, deposit taking.
So they didn't need to change that entire or get a new.
So anyone now who wants to offer that product as a financial product, yes, they're governed by that law, which means that it opened up to anyone. If you're a bank and you want to add that as an asset class, you apply. If you're a fintech, you apply. If you're a new company like Yellow Card, where for you that's your main business, you also apply. So that's how they've had so many licenses within the industry. So you'll see that for South Africa, they're going to have companies that have both traditional licenses, like a banking license, and at the same time you have a CASP license. We're not seeing that anywhere else. If the only one that's going to be now also allowed in Kenya, it's slightly different for Kenya, because for it, the crypto company or the company that has a license will be allowed to do all the things that crypto does. But that doesn't mean that I have a banking license or that a bank can also apply. We are still unclear about those things. What we've previously seen in economies like Kenya, common law economies, Nigeria, Uganda, is that you have to create a different entity to apply for that license, because they say they have this rule of one license, one entity, something like that. So far, South Africa is taking the lead Nigeria will inevitably be out there, and then Kenya has also a very progressive law. So we are yet to see where the Kenyan law is going to take us. Very hopeful.
Yeah. But I'm just curious, now that I mentioned earlier that banks are now becoming more flexible, they're willing to actually look at the crypto direction. Now, will they be governed by this new bill, or will they be governed by the already existing bill that actually governs the banks themselves? That's, I don't know.
So that's that's half and half. So for banking, they already have their laws that work for them. So what we've seen in certain countries is that once there's a law that governs virtual assets, it now means that's regulated business that you can do. So what will happen now is that the central bank will say, since this is now regulated business which we can do, we are going to decide what percentage of your assets you can put in this business. The same way, banks have very strict regulations on, for example, how much money you can put in Forex, how much you can put in Fintech, how much you can put in deposit taking. So to spread the risk, what we've seen around the world is, for example, the US banks are allowed to put like 2% of their portfolio in crypto, either ETFs or crypto assets. So it's going to be something like that. So they'll tell the banks, you can put, it's still a growing industry. So for traditional finance, you'll see they'll be telling them, put 2%. Now we have moved to 5%. Now we've moved to 10. So the percentage will keep increasing as the regulation tightens and the industry becomes more mainstream. But for now, globally, we've seen banking has been allowing about 2% of your portfolio in crypto. Yeah,
that's promising. And maybe just as we almost come to an end, we have like almost winding up. Do you envision at some point a Pan-African or regional framework, maybe led by organization like African Union or even the African Continental Free Trade Area? I mean, do you envision such a framework someday?
For sure, because already AU and the African Free Trade Area are doing PAPs. So I see them doing a very parallel thing in crypto, very similar, or in what you'd call non-traditional finance, very similar to that. And it's probably either going to merge or even be parallel, but definitely going to happen. I don't know if you've seen the socials, but we are partnering with Visa. So what does that mean?
Yes, we
exactly.
Yes,
so if you're having traditional payment rails, it's going to somehow be merged with stablecoin payment rails. And also, since the US has now passed the Genius Act, I don't know if you've seen in the past couple of weeks, which regulates stablecoins. For it's strictly on stablecoins. And the reason why stablecoins is so important is that it's a digital representation of value. So, and the reason why for it's less risky is that money actually exists. You get dollars, or if they decide to create a Kenyan stablecoin, you back it up either in treasury bills or bonds or any securities, and then you offer that on the digital form. So instead of people moving around buying physical dollars, they are still able to buy the dollars on the digital form, and these actual dollars exist in treasury bills, bonds. So it's not some hearsay, made up money. The money exists. And because the money exists, it's easy for those rails to work within the same traditional rails. So these partnerships with Visa, even entities like the African Union and PAPs, you're going to see those same rails possibly being used for stablecoins as well. What I'm interested to see is how the African currencies are going to have stablecoins and how that's going to work. Because we still have, we rarely transact in our traditional currencies as Africans or even as any part of the world. Almost everyone, when they're doing a cross-border transaction, the moment the money is moving to, is crossing the border, they now move it to USD. If you're lucky, maybe Euro, if it's in Europe. But I want to see a scenario where we have country stablecoins and we're transacting with each other, and it's all, digital. It's going to be interesting.
Right, of course, and we look forward to that future, which we hope is going to happen soon.
Definitely.
Maybe, as my last question to you will be, from your perspective, what does, a secure, inclusive, or sustainable digital assets future for Africa look like?
The way it looks like for me is that anyone can participate who wants to participate and is ready to sort of be a good player within the industry. And then it also it's like limitless. Yeah. The thing about human nature is that when something is new, we fear it, as we should. But also, we should allow, the way I see it is that money, digital assets are going to change form so much that will be like how our parents, how grandparents say, I don't even know what you people are talking about. So I see the future as, first of all, limitless, and then allowing for innovation and things we could never have thought of. And I also tell people, if you think you're scared of crypto, you wait for what comes after that. Even the people in the crypto space will be like, what? Wow. What's this? And then I feel like we're going to move towards where money and doing business and also just moving things is so easy. Right now, it's so difficult. Yeah. I'm going to give a vivid example. I know we're about to run out of time. I got married last year. And my husband is Kenyan. That's why I'm here. The things we do for love. And he had to send money from Kenya. And we first tried the traditional means. And I was like, where?
It's so expensive.
This is so expensive. We now tried, we're like, M-Pesa. We tried M-Pesa.
More expensive?
M-Pesa was so expensive. Do you know we had to use yellow card? And then someone at the company laughed at me and told me, but Edline, you work here. And I'm like, I didn't know how cheap it was. So now the entire family had to sign up because now the friends are sending, then his friends are sending, and then my friends are sending. And that's how the ecosystem works. And then because the money is moving and it's really moving, I told my dad, and then he had to tell his uncle, and then his brother. And I'm like, we're going to reach a point where it's so easy for us to move money around as it should because the money is ours and we make it. And then also the ecosystem is going to be intertwined. Banking, rails, you know how it's so hard for people to access banking and people are unbanked. It's going to be so easy for the people who cannot access these services now to easily access them. And it will be like one fluid ecosystem moving around all together. That's how I see it.
All right. Thank you so much, Lee. And what more should we expect from Yellow Card?
A lot of partnerships. There's just keep watching the space and watch the news. A lot is happening. It's been very busy. We had the regulatory report. We had the partnership announcement with Visa. We had one with Merge. So we also have some very interesting products with what I would like to call traditional finance that are very, very sustainable. So also a lot of that around that space. Yeah,
I was waiting for you to give us a scoop. You know, we are a publication, right? So,
I can't say anything concrete.
But thank you so much, Dean, for joining us for this episode, and of course for shedding light on this important report. You know, of course, it's clear that adoption grows, we think about smart regulations, and also, you know, of course, this regulation should be okay in protecting users and, of course, unlocking even more innovations, especially for the countries that we mentioned in the report. So if listen to this podcast and you've not read the report, we've covered the report on our publication. We're going to share the link to that report as well. And of course, you can as well just follow Yellow Card's work in building Africa's stablecoin infrastructure. That's it for this episode. My name is Nick Anali. I'll see you in the next one.
Thank you.